stock market sold off today, and it sold off pretty much for the whole week. I wanted to break down what's going on, looking at the bond market, because this is the main focus of what's going on in the stock market, and it looks like this is going to stay for a while. My expectation is for the bond prices to kind of ease out a little bit, but higher for longer will be the mainstream. From here, we'll probably see a newer sort of range for the stock market moving sideways until we get more information out of either the Federal Reserve via some economic data that tells us they need to raise interest rates even further. Should that occur, stock market will sell off sharply. I'm not in the camp that says that bond rates are going lower next year at all. In fact, I see a lot more headwinds than tailwinds. Let's jump in. I want to break down the entire stock market, do kind of a stock market review, showing you what happened throughout the week, what we can expect next week for the stock market. Let's jump in. If you are joining me for the first time, there are links down below. This is a new channel. It's a breakaway channel from my original channel. Follow those links. You can get to my website and get the free email newsletter where I send out whenever I have new content for the day. What we're looking at here is headline inflation and core inflation. And as you can see from these charts, we've seen some big moves upward. And this is the effect, not the cause. This is what we're looking toward to answer the question, how much higher, how much longer? There's a lot of factors that play into this. There isn't just one factor. There's not one little pill that we can all swallow and everything's awesome. That there is usually a multitude of factors. In this case, when it comes to inflation, you've got the Federal Reserve who expanded the money supply by boosting their own balance sheet significantly. The Fed then left interest rates too low too long, something they've done before after the 2008 crisis, and now we are paying for it in the price of higher prices across the board. Housing, of course, is in a weird bubble because of such low interest rates previously. You'd have a lot of people who are not going to sell those homes for 30 some years simply because their mortgage is locked in at an incredible rate that they will never see again. Simultaneously, supply, the way things are moving with supply, it's just not high enough. People are either stepping in or stepping out. Mortgage rates are too high comparatively. So when it comes to inflation, housing is a real factor. We can blame the Fed on that as well. Here's a look at the Federal Reserve balance sheet. Now, we were on a trend line from the late 1980s into the early 2000s, and the balance sheet kind of kept a modest approach. Then, of course, the balance sheet shrunk around 2001, but then in 2008, the Federal Reserve needed to significantly increase their balance sheet because of the financial crisis. They did so over a period of time, starting at about 2009 and stepping up, and then a third quantitative easing, stepping up even further to get growth to certain levels. And if you go backwards, looking through what would be the tail end of pretty much all through Obama's administration, basically. Obama walked into a mess. You'll recall the financial crisis occurred in 2008. Lehman, I think, tapped out in September 2008. We had an election 2 months later. Obama stepped in and had to deal with it. The economy wasn't necessarily robust, but it increasingly got better and better. And it really largely boils down to the actions of the Federal Reserve. The Federal Reserve has their hands on the steering wheel, both foot pedals, the brake, and the gas. They are the ones who really steer the economy through monetary policy. From time to time, Congress can get together and actually pass legislation in the form of fiscal policy. But that's like trying to get an act of Congress to pass. So it's not really something reliable. That's why they leave the Federal Reserve to do what they're doing to control the money supply. One of the ways they control the money supply is through their own balance sheet. And as you can see, things got a little crazy in 2020 with the COVID lockdowns. Here's a look at the money supply, and it's almost about the same time frame of chart. So if you we're able to look at that. You can go to tradingview.com and get both of these charts and kind of look at them yourself. The money supply is really sort of the gasoline in the engine, if you will, if not the engine itself. It's hard to kind of give you a parallel with that. But if our money supply is expanding, it's both a cause and effect because we're in a fractional banking system. And our money supply has gone too far, too fast, too long. The Federal Reserve left things on too long and sat there and said our inflation was transitory. They were dead wrong. Then they had to hurry up and catch up. Simultaneously, the money supply or their balance sheet was too high, and they are actively trying to shrink it in order to contain price growth. There are pros and cons to this. First, the higher interest rates is actually attracting in more money from the outside world. You have Japan, where Japanese investors are getting negative interest rates, negative 0.15%, meaning if you give the government money, they're not going to give it all back from that debt instrument. So Japanese retirees tend to look abroad for investments. And on a comparison basis, the U.S. 10-year Treasury, which is yielding roughly 5% today, is far more attractive. And if you follow the U.S. dollar, you're seeing that the dollar itself is rising continuously because money is flooding in. So on the one hand, the Federal Reserve is actually trying to shrink its balance sheet and shrink the money supply in order to contract price growth. But more money is showing up. So there's ripple effects to all the things that have occurred. There are, and here is a look at the U.S. Treasury yield over the past 4 or 5 years. This is the 10-year. It did touch 5% today, kind of tapped out a little bit towards the end. The stock market didn't really like what was going on. Sold off 1.15%, which is a little more than normal. An average daily movement is about 0.85% per day price change, up or down. 1.15% is a little more, but the moves have been contained just continuously in one direction. The 10-year bond, I really think we're probably getting close to where, with the information we have now, where the bond yields will remain for some time until we get more information. Unfortunately, that more information might come next Friday. Next Friday, we get personal consumption expenditures. This is the inflation data point that the Federal Reserve actually looks at. They don't look at CPI. There's 2 data points. They're about 2 weeks apart. CPI shows up. They're fairly similar, but PCE is a little more sensitive. CPI shows up about 2 weeks prior to PCE. So the market already has a pretty good idea as to what the PCE is going to look like. However, there could be a surprise in there. We don't know. The following week, we get employment data. What if employment data remains robust? And for those of you who didn't catch last month's, or actually this month's data points, from the 1st of October, I think it was October 4th, we got that data point. September's jobs report was exceptionally high, robust. It was a wow kind of report. They also went backwards and revised the 3 previous months higher. So the economy, the consumer, is still pushing forward. And retail sales, which we just got last week, shows that not only are a lot of people still employed, they're spending a lot of money. This is going to pressure inflation. So if we see any kind of uptick in core inflation on PCE or 2 weeks afterwards, CPI data, the 5% on the 10-year could get blown out. For now, however, short-term interest rates from the Fed are about 5.5 to 5.75. The longer end of the yield, the 10-year, 20 and 30, is adjusting to what the Federal Reserve is doing with the short term and the fact that they are leaving interest rates higher for longer. All that's happening on the long end of the curve is that it's adjusting to that higher front end of 5.5 to 5.75 with the expectation that interest rates are not going to move lower rapidly. And the Federal Reserve is going to leave these interest rates higher for longer. But there's another factor. So you have the Federal Reserve that's creating all kinds of liquidity via much higher money supply, much higher balance sheet. There's one more factor, and that is the federal surplus. And here we're looking at a chart, federal surplus as a percentage to GDP. The big spike up right in the center, that was Clinton. And Clinton just happened to be one of the luckiest presidents on the planet because he happened to be the president during the period of time when the dot-com era was taking over, basically. Of course, that didn't end well at the end, but nonetheless, our economy has transitioned significantly to online internet. And for a brief moment, the U.S. government, for the second time in the past, say, 75 years, ran a surplus. All downhill from there. What happened after that, of course, was September 11th. Bush launching 2 wars, and then ultimately, when Bush left office in 2008, January 2009, he handed the keys to the front door to the White House to Obama during a financial crisis. So the economy contracted significantly. You can see that drop right there. Obama kind of picked things up a little bit, or during the period of time that Obama was president, the Federal Reserve picked things up a little bit. Things moved forward. We got to a debt to GDP ratio that was low by normal standards if you look backwards, even though we have some ups and downs. Trump, of course, took over his tax cuts, plain and simple. He gave a lot of tax cuts. There was no new income coming in, so there was a shortfall. Then COVID. What we're seeing now is there's a lot of supply of debt. So the Republicans are trying hard to contract the deficit. Sounds great. They're looking at the wrong problems. They're looking at the discretionary spending, which is about 1/6 of the entire budget. No one dares touch Social Security, Medicare, or defense. That is such a huge portion of our debt. But no one would ever touch that because that's your nail in the coffin for getting reelected, even though that's the biggest portion of the problem. So we'll see if that gets addressed. But this shortfall in tax coming in versus what the government is spending is creating that deficit relative to the GDP. And that means more paper, more supply. So the Treasury has to go to the market and try and sell this paper. There's a lot of supply out there. And demand is shifting. China's not buying as much. Japanese investors are not buying as much. In fact, China is actually selling. While during all this time, the Federal Reserve is also selling off their assets because they're shrinking their balance sheet. So there's a lot going on with the bond market right now, and this is pressuring, of course, stocks. Here we have a good look at the S&P 500. Like I said, what I'm looking at, I see bond yields kind of with short-term rates where they are right now. The long end is sort of moving higher with where short rates are, and simultaneously higher for longer as the mantra. If that continues, we should see bond yields kind of leveling out right here. I can't imagine the 10-year going to 5.25. I seriously don't see it going to 5.5 given the information we have right now. In that case, stocks like TLT Stock. TLT Stock likely will have hit the bottom. I don't see a rally. I just see that we're probably not going to see much more lower with TLT stock up until we get more information. If we get inflation data that starts popping up, TLT stock is gone. SPY stock, SPY stock, gone. Because yields will move higher. This will force the hand of the Federal Reserve. The long end of the yield curve will have to adjust upward. The ripple effects throughout the economy, this is really going to be sort of a big effect, because what will happen is the federal government is going to have to pay attention. They're going to have to sit there and say, yeah, you know what? We really need to do something about this deficit, period. Somehow we have to bring in more revenue and spend less simultaneously. When the 10-year was sitting at 0.5%, you could borrow till the cows came home, no one cared. Simply because it was almost free money. It was lower than the rate of inflation. Things are different now. The stock market, SPY stock, shot through the roof. SPX, whichever one you look at, because there was so much liquidity, because everything was, the Federal Reserve had the pedal to the floor. Those days are gone. All right, the proverbial punch bowl has been taken away. The lights are on. The party is over. Now we get to deal with the headache from all of that. There's too much inflation. Federal Reserve needs to contract that. Get us to a more normalized economy. Now, the soft landing scenario isn't entirely dead. It's just going to be really difficult to nail from the way I'm looking at it. Because things are exaggerated so much with the money supply and where interest rates were, I think that they're going to have to contract so much that they contract the economy to the point of a recession. Then you'll see stocks like TLT stock start to take off, because at that point the Federal Reserve will then be flipping, saying, okay, we've contracted the economy. Inflation is where we need it. Now we can start lowering interest rates. But we may be at a new norm when it comes to higher interest rates across the board. We've had some pretty good times with regard to interest rates being very low. They may be gone as well. We'll see that information as the years go by and as the economy develops from there. But when it comes to, here we're looking at SPX or SPY stock, a bit of a sell-off today, and I think we're probably likely going to mellow out about these areas until we get more information. Now, the Federal Reserve just told us that they think they may have to raise interest rates, that they don't think that it's at an appropriate level at this time, that there is room for more moves higher. Bond market didn't really move off that, but the stock market sure did as things adjust to that. I'll keep you guys continually updated on this. Make sure you hit that like and follow button for this new channel. As well, feel free to follow the links down below to get my free email newsletter to keep in touch with all the content, and click to the website. We'll see you in the next video.